What's up, everybody? As you guys are trickling in, happy to have all you guys here again on the next Fixated on Real Estate webinar. We have some legends in the industry joining us here today. I'm very excited to be able to have these guys on here with Ken, Mauricio, and Jay. And you guys are in for a treat, or you're in for doom and gloom. I don't know. We never know when we go over these webinars. You're either like pumped up, like the future is bright, I'm excited, or holy crap, I got to sell everything and, pray to baby Jesus that nothing happens to me, right? So we're going to find out, right? I'm really excited about this. So today's webinar, we're going to go over what's happening, of course, in the residential as well as multifamily market, what's happening to landlords out there. We're going to answer a lot of your guys' questions. We're going to jump into raising capital and what Mauricio is seeing out there in the industry for people and investor confidence when it comes to raising capital. And we're also going to talk about when to start buying again if you aren't already buying right now. So that said, let's go ahead and jump into it, guys. I'm happy you're here. So I'm going to first introduce the legendary, the myth, the man, the legend, Mr. Ken McElroy. Ken.
You just call him McElroy?
Is it McElroy or McElroy, right? I always say it's McElroy, right? Or is it McElroy?
Well, it's McElroy, brother. Come on.
That's what I knew it. I say it all the time, right? All right, Ken McElroy. He's a principal at MC Companies for 2 decades. Ken McElroy has experienced great success in the real estate world, from investment analysis and property management to acquisitions and property development. With over $1 billion in investments in real estate, Ken offers a unique perspective on how you will get the biggest return on your investments. He's author of the best-selling books, The ABCs of Real Estate Investing, The Advanced Guide to Real Estate Investing, and ABCs of Property Management. He's also rewriting a whole bunch of books. He's got more books coming out here soon too, so watch out for that. He is an advisor to Robert Kiyosaki of the Rich Dad Company, and Ken is also a chapter contributor to the Rich Dad book, More Important Than Money as an Entrepreneur's Team. So give it up to Mr. Ken McElroy. Right.
Yeah, thanks, Carl. Thanks. Good to be on here again. Appreciate it.
Happy to have you again. If you guys don't remember, check out our first episode of this webinar, April 1st, on our YouTube channel. You can see Ken there when we didn't know what the hell was going on in the real estate world, when the market started shifting and we all got locked in our houses. It's very interesting webinar. So check that out. Then we have Mauricio Rauld. How do you say your last name?
Rauld. Yeah, that's good.
Rauld. There you go. See, I'm working on it. Rauld. Mauricio Rauld. He is CEO at Premier Law Group. Mauricio is one of the premier syndication attorneys in the country, helping real estate syndicators raise hundreds of millions of dollars to pursue their dreams of financial independence. Mauricio is founder and CEO of Premier Law Group and spends 100% of his practice on syndications for real estate investors. With over 20 years of securities experience, Mauricio specializes in Reg D exempt offerings and educates investors from around the world on how to navigate the complex world of securities laws. He's named as one of the top attorneys under F.O.R.E. Are you under 40?
Not anymore.
Not anymore. Right. So, by Super Lawyers Magazine, Mauricio regularly shares the stage with real estate guys like Robert Kiyosaki, Ken McElroy, Brad Sumrock, and Peter Schiff. Yay, Mauricio. So,
thanks for having me, man. Looking super excited about doing this.
I'm happy to have you. So now, last but not least, one of my best friends in the whole wide world, Mr. Jay Scott. Many of you guys know him. Many of you guys love him. He is CEO and author. He is CEO of 123 Flip and author of Bigger Pockets, many, many books, pretty much all of them, I think. So I think that all 30 books Bigger Pockets has, Jay's written all of them, or at least 4 or 5 of them. He's an entrepreneur, technologist, and investor and advisor. He's host of the Bigger Pockets business podcast. He's author of 4 Bigger Pockets books, including the book on flipping houses, the book on estimating rehab costs, and the book on negotiating real estate, which are all behind him right now. And he is also an author of the Recession-Proof Investing, Real Estate Investor. He's completed over 400 deals since 2008, buys and holds, syndications, all sorts of great stuff. Love the guy to death, and I'm always happy to have him joining us. So, Jay Scott, yay! So, Ken, it looks like you're having a little bit of a connectivity issue, but that's all good. Hopefully you can understand anything I'm saying. So when we had you on here April 1st, rent was due. None of us really knew what was happening in the world. We kind of thought the real estate world was going to go to crap really fast. And we didn't know if you're going to get your tenants to pay rent. So what has happened in your business since April 1st? What have you seen in the multifamily space? Have you got your tenants to pay? What's going on?
Yeah, thanks, Jay. Well, I'll tell you what, Tarl, we really thought that, multifamily was going to get hit hard because if you remember going back, I think Jay and I were the only ones that were considered pessimists at the time, because Trump said, hey, no evictions, which it doesn't mean they don't have to pay. But we were embracing for, this is going to be bad for us and we're going to have to talk to our lenders and our vendors and all that. What's happened is we ended up rolling out virtual leasing, virtual rent collection. We have chat bots. We did all this stuff in like 2 weeks. Like our whole company like changed in basically 2 weeks from what we've been doing for years. And the results have been good. So if you think about, by the time this really hit us, which was call it mid to late March rent had already been collected and most people were working through March. So April ended up being at we collected about 99%, which we were really, really happy with. And then we're like, okay, May, we're going to get annihilated because now these people haven't worked for potentially up to 6 weeks. And so far in May, we also collected about 99%. So, and I think that was largely due to the stimulus money that people got, through unemployment or, through the $1,200 checks or whatever it was. But we've been pleasantly surprised. And the one big thing that happened was nobody moved.
Nobody moved.
So that's a big thing. Like when people move out, you got to have them move back in. Well, nobody was moving during this. And so our occupancies stayed really high and they're still really high right now. So for the multifamily industry, it's been a very, very blessing, and it's been a soft landing.
That's great to hear. So that's something that's interesting about the nobody moving out. And because normally you're projecting that you're going to have all these turns and all these expenses. So does that mean that your expenses and costs actually went down or?
Yes. So that's it. Exactly right. So, okay, think about it. So the first thing I did was I went to our company and I said, listen, because we have about $8 or $10 million going in renovations at all time. And I said, stop, no value adds, like that's over. So we stopped that. Then I said, no marketing, no, what are we going to do? It's not like we're trying to attract people. So we stopped that. And then we were able to cut back on, a number of other things on the maintenance side, as you just pointed out. So our operating expenses went down a lot in the last 60 days. And so the question I had yesterday on our Zoom call with our whole company was, okay, so now that you've been able to cut 30% out of our operating costs, you got to go through me before, you put those back on. And, so there's a lot of good things that have come out of this. And that's been, just really taking a look at every single expense line item and then just being grateful for every single income line item. And, it's been rough. It's been tough. As you know, we're on the front line. So, we have a lot of COVID patients that live in our properties. And so, the maintenance guys are there trying to deal with those. And, the PPE stuff that we've had to do with our teams and, we're virtual in a lot of ways. So it's kind of the new normal. And honestly, a lot of this stuff's going to stick, Tarl. It's not going to go away. I mean, These are adoptive things that we're going to be doing. The chat bots, as an example, they direct people. They direct people to maintenance. They direct people to leasing. And, we've got this thing all rolling on virtual leasing. Well, that helps people and it reduces our overhead.
That's crazy.
I know.
For those of you guys listening to audio later on the replay, my dog just opened up my door behind me. So he wanted to see me. So anyways, he's like whining, pushing it. All right. But that's all great. I mean, that's interesting. That's extremely interesting. Like right now, I know on our end, we actually have a handful of single families that we're putting on the market for rental right now. We do a lot of the BRRRR strategy, buy, rehab, rent, refinance, repeat. And we have about 6 that just all of a sudden got finished in the last couple of weeks. And there's more getting ready and stuff done right now. And we had a couple of re-ups and we throw them on the market and it's like mayhem, even on the rental side for people to want to rent these things out, at least in our neck of the woods right now. And we're actually having to raising rents, not from existing tenants, but we're pushing our rent, like going like, oh yeah, let's raise it up this before we put it on the market to see what happens. And it's getting gobbled up left and right by highly qualified people. I don't know if you seeing any of that at all, or is it you're in a different market than me a little bit, but when you're going to actually start to put new product on the market, are you seeing that you're getting it rented out right away or no? Ken, are you having connectivity issues?
Oh yeah, sorry.
So, all right, we'll come back to you, Ken. So,
Okay.
Mauricio, so you're in you help syndicators, you help people like Ken raise capital. You help people similar to Ken in many industries, not just is it all real estate related for syndication?
Yeah, so I help, exactly. Ken is a syndicator. He raises capital to buy buildings. And so I represent syndicators that are buying 100% of my clients are real estate investors. Most of them are multifamily, but we certainly do, mobile home parks and self-storage and some single family portfolios. Yeah, I'm the one that makes sure that when Ken's raising money, that he's not violating securities laws and not breaking federal or state securities law. So I just make sure that you stay out of jail.
So with that said, right, and luckily Ken, we never want Ken to go to jail. So you have there's actually a lot of clients that you have that we're all friends with and stuff too, that many people listening to this would know. So Mauricio's, top notch at what he's doing. We've had in past webinars other guests saying, hey, raise capital. Now's the time to raise capital and stuff and prepare for the future. You actually are on the front lines of that, like seeing investors raise capital. So what's your experience right now with investor confidence and what's happening out there? And are people trying to raise capital, preparing for something, or trying to buy now, or what's going on?
Yeah, it's interesting. So we do quite a bit. I personally, I think last year we did about 100 offerings last year. So we see quite a few of these, but literally from probably the middle of March till the beginning of May. So that 6-week period, it all, at least in our office, it all dried up. Like nobody out there was looking to raise capital. I'm not saying that nobody did raise capital back then, but most people put the brakes on it. And I think most of the reasons were because there was so much uncertainty. Just from the lender standpoint. We went through that period where the lenders, were freaking out and they were, putting pauses on the loans or pulling the loans the last minute because they had no idea what the effects of the pandemic were going to be. And so I had a lot of clients who were in different stages of the capital raising exercise. So some of them were, had done raising all the capital and they just were ready to close, and the closing got delayed or pushed back. And then I got a lot of clients who had just started and were in that due diligence period. And so they were able to back out. And then there's a lot of people that kind of started, but then just put a pause on it. And so for that 6-week period, we saw zero activity on capital raising. What I spent most of my time, interestingly enough, during that 6-week period was 90% of my phone calls were with people who are now interested in putting together funds, meaning they were wanting to raise a bunch of money into a fund with the expectation that later on this year, there'd be tremendous opportunities for them to go basically pick up bargain deals, pick up things that are cents on the dollar, and they wanted to be ready, or at least start, a lot of people have never done funds before. So they always find a property and then they raise the money for that project specific, right? But the idea of a fund is sometimes they've heard about it, but they don't really understand exactly how that works. So I spent the last 6 weeks, really last 2 months now, educating and talking about how people want to put together funds, because there's this huge demand, at least what I've seen, of people now focusing more on, hey, there's going to be all these great deals in the near future. Let me be ready to go and have the capital in the bank so that I don't have to worry about raising capital. But so, and then probably in the last 2 or 3 weeks, I've started to notice kind of people coming back. We started having more people start the capital raising process again. And a couple of funds and a couple of project specific. So, but there was a time there for 6 weeks where it was completely shut down for a while.
Crazy. So what does that mean? Like, what does that mean as far as investors are concerned? Like, if people are coming up to you right now trying to, like, almost in droves, it sounds like, I want to start raising funds, I want to do this. Like, what are your thoughts on all of that? Like, do you think that's a good time to start raising capital or not?
Well, there's two parts to it. So one is the syndicator. So somebody, again, like Kenny or Jay that wants to go raise capital, sees opportunities in the market, believes there are great deals out there. They're all excited. They would love to go raise a bunch of money and start taking down properties, at least from the feedback I'm getting. I mean, I think after what happened in April and May with rents, and there's all this fear about what's the economic vacancy going to be, what's going to happen. They feel pretty relieved that April and May went okay, and they feel like the worst is behind them, and so that's why I think they're coming out of the woodwork now and proceeding. The biggest unknown is really the investor base, right? Like so the syndicator might be all excited, they may see opportunity, but now they've got to go raise the capital from investors. And I believe that with in general, if you haven't done the work ahead of time and cultivated a really strong investor base and really come up with sort of a trust factor, like Kenny has and some others do, where if they came out and said, look, this is a great deal, they've got that confidence in the operator, versus somebody who just now needs to go find new money. That's going to be the hard part. But if you've really cultivated a good investor base, I think you can, and people have been raising capital from that base. But we'll see now. There's a lag, right? So now it's how the syndicators are now starting to come out of the woodwork. And now the question is, are the investors going to follow and start making investments with the syndicator, given what's going on with the stock market, or just their own personal situation and how confident they feel, in the next 6 to 12 months.
So Jay, you have invested in syndications, or you look at it at times, and you have money, right? Yay, right? Don't tell anybody. But what would you right now, if somebody brought you a deal to invest in as a syndication, and would you invest in something right now, or what would make you want to trust somebody to invest in that syndication or trust the deal in some capacity as an investor? So, and that's an actual passive investor putting money into the syndication.
So it's a weird answer for me on this, simply because yes, I've invested in I don't invest in a lot of syndications. I like to control my deals. So, but I have invested in a few here and there. And more recently, I've invested in a couple mobile home park syndications, because I do like mobile homes leading into an economic downturn. And so I kind of been expecting this for the last year. Late last year, I invested in a couple of mobile home park syndications. That said, whether I'd be investing in multifamily syndication, well, the interesting thing is I'm actually leading, or I'm partnering with, I actually a small role in leading a syndication, my first syndication deal. So we did find a deal that we had locked up in February, March. We backed out, and then over the last 2 months, we've kind of been keeping in touch with the seller. We submitted a new LOI a couple weeks ago, and we just came to an agreement at a decent discount off the original price, off the March price. So we are doing a deal right now that's a syndication deal. I think it's a little bit better than a lot of the deals that we're seeing out there. It's basically entry cap rate is about 6%. So even if we didn't touch it, even if we did no value add, if we didn't raise rent, if we didn't put any CapEx in, it should cash flow, and compared to the market cap rates in that area at around 5.1%, it cash flows pretty well. So I'm comfortable with that deal. But whether I'm optimistic about multifamily not taking a hit, I'm going to say no. I think multifamily is pretty well insulated compared to a lot of other real estate niches. But I think even multifamily has some risk, especially over the next year or two. I think longer term, if you're looking 3, 5, 10 years out, I think multifamily is pretty well positioned especially compared to things like retail or commercial office space, which could have, troubles forever, could be going away. But multifamily, yeah, it could be a rough year or two, but I think it'll rebound pretty quickly once the economy turns around. And I guess when the economy turns around is a bigger question there.
What does that look like? So, Ken, you actually had said, I think on our first one that we did, that don't buy value adds, or like no value adds or something like that when it came to multifamily. And and we also I know all four of us on the webinar on the first one were like, I think multifamily is going to take a hit, right? We're all like, is it commercial and all this kind of stuff, and we all, like everybody listening to this, we're all taking, what's that word? We're making predictions, right? Which are basically educated guesses most of the time, right? When you're looking at that. So when you see all these like stats out there and these experts making predictions, that means they're guessing. I just spoiler alert on that. But for us, that's what we're trying to do the best we can to make our investment, decisions, and we're sharing them with you guys. So with multifamily right now, Ken, and what Jay just said too, like, do you still have the same predictions with multifamily? And that not to buy value adds if you can, or like all this kind of stuff, or hold off, or what are your thoughts?
Well, okay, so I'm going to go back to 2008. And so, you know, for me, yes, this is a virus. 2008 was a bank crisis, you know, call it what you want, but we're honestly, a lot of the fundamentals that are happening right now are what are happening today. Some are different, some are not happening, you know, so, but generally it's very similar. And so, you know, what happened then is people lost their houses and they flooded rentals. That's actually what happened largely, or they lost jobs and they were downsizing and all those kinds of things. And so we haven't seen that yet. And so I think what you're going to see, I made a prediction that I think we're going to have 18 to 20 million people unemployed by the end of the year. I really believe that number, you know, based on, I think we've grown it up to 32 million plus, because we started with 5.8 and now we're in the, you know, call it the mid 30s. So, and there's a percentage of businesses that are not going to go back. And so the reason I bring all that up first before I answer your question is because those are real people that had real jobs, real savings accounts, real cars, real gym memberships, real, you know, real behaviors and going out to dinner and all that stuff. So all of those folks, a lot of them are going to take a big financial hit, and that's going to affect multifamily, I think, on the value add side. In other words, there's still, obviously, there's still going to be people that are going to be, you know, moving into the class A's and the you know, and the nice new stuff. But I've seen both, and I've been through multiple cycles. And you know, at the beginning of 08, you know, there was no construction, no new building, and no, you know, brand new class A stuff. And what happens is the class A stuff went up like this, and then the B stuff, there was a big gap. And then, so then there was an opportunity to pull the B's up to the A's because there was such a big gap. That's actually what happened. And so what you're starting to see right now, even in Scottsdale, which is where I am, we have properties that are open. You know, we're a builder, and they're doing 1 to 2 months free on a 12-month lease just to fill them up. Okay, well, I don't have to tell you, you know, that's competing with B's. Yeah. So, you know, you can't give away 2 months on a 12-month and not be competing with B's. So I still see a fairly big disruption, but we're still in a housing shortage. That's the bizarre thing. You know, we never really, the demand is honestly still there. But, you know, and the supply never really actually caught up when all this hit. So it's a confusing time for many. And so we said, listen, you know, and by the way, I already own the property. So I might have a property where a 2-bedroom is 1,100 or 1,200. And, you know, can I get it to 14 or 15? Maybe. But, you know, I'll just put it in my, you know, in my belt and bring it out another day. You know, I'm not basing my value add strategy on a bunch of money that I raised that I'm trying to cover, you know, from some preferred return, or I'm behind a preferred return or anything like that. So I still think that value add's risky until we kind of see what the new normal is, especially when the people run out of money at the end of July right now, which is still on the table.
So you had posted a video on YouTube, on your YouTube channel. For those of you guys, look up Ken McElroy on YouTube. And you and Robert Kiyosaki have some predictions of what's going to happen and what's going to go to the market and when the time to buy is and all that kind of stuff. So if you guys have, it's about a 20, 25-minute video, something like that, I believe. And the whole video, you still stand behind that video and your predictions?
I do. Yeah, right. I do. It's just, guys, it's so early. I mean, we're just 2 months in. I mean, you know, prices were still dropping from 2008 to 2000 through 2010. You know, it just, you know, we're just now seeing an unraveling, and people are delusional. Mm-hmm. And, you know, and they're in denial. You know, they're like, they don't want to believe the fact that we're going to have 18 to 20 million people unemployed at the end of the year. And, you know, their favorite restaurant, their favorite gym is going to be gone. I mean, you know, they just don't believe it. You know, and I'm sorry to say, I got friends that own malls. I got friends that own retail centers. You know, they're done. I mean, they're saying 50% of those people are going to be gone. They're collecting right now 30, 40, 50%. I can tell you that does not cover your debt payment. It does not cover your operating expenses. So, you know, you're going to see retail centers and malls be repurposed. And then, of course, the anchor in the malls, Macy's, Sears, you know, those guys are done.
Yeah.
You know, they filed Chapter 11. So, you know, it's all starting. It's all going to happen. And I just really feel like it's a good year to step back and follow the trends, because we still have a housing shortage. And, you know, it's funny. I'm going to actually I'll give you a little sneak preview. I'm going to do a little video on YouTube that's going to talk about, during the pandemic, what are the trends, you know? Well, divorce is a trend. I know that sounds odd, but the fact is that creates another household. That's good for real estate. You know, those are trends. Those are things that are happening. If you Google divorces in China, you'll see that there's a massive increase in divorces in China because of this lockdown. And so why wouldn't it happen here? So those are trends, and those are things that you got to follow, because there's still money to be made.
I'm going to go a step further than Ken, and I'm going to say, Ken said we're 2 months into this thing. I'm going to say, I don't think this thing's even started. I mean, if you look at housing right now, everybody's looking around saying, oh, wow, housing's doing really well and prices are staying strong. And in some places prices are going up. But that's not real. Because of the pandemic, we've seen both constrained supply and constrained demand. People are staying in their houses. They're not going out looking for houses. They're not listing their houses. But one of the things that we've seen is that there's been more constraint on the supply side than there has been on the demand side, which makes sense. I mean, it takes a lot more commitment to list your house as a seller than to go out and look at a house as a buyer. I can decide tomorrow, yeah, I might want to buy a house. I'm going to go out and start looking. If I find something great, I'll buy it. But as a seller, you can't say I'm half in, half out on selling. You've got to say this is a commitment. And a lot of sellers, it's easy to say as a buyer, I don't mind walking through somebody's house. I'm just not going to touch their stuff. If I'm concerned about the virus, I'll wear a mask. But as a seller, you can't just take those precautions. You have to worry about people walking through your house. And so sellers are a lot more hesitant to kind of take that leap right now than buyers are. So supply is more constrained than demand. And anytime supply is more constrained than demand, you're going to see prices hold steady or go up. So the first question we have in our Q&A that's been upvoted is, what are the thoughts on when we might see the residential market start to decline? And the answer is, we don't know if it's going to go up, go down, or stay the same, but we're not going to know that information until things open up, until we see till we see how much supply and demand is out there. Because right now we're in a really inefficient market, and just artificial constraints on supply and demand. And it could be weeks or months before we know the true impact this has on real estate, positive or negative.
I guess that makes sense, because so me, I invest in single family. That's what my bread and butter. I flip houses, but we also keep a lot for rentals. And I listed a house last week on Wednesday or Thursday, can't remember. In 24 hours, we had 7 offers on it. And looking back, I'm like, we listed for $325 and it went pending at $351, right? So I'm like, sweet, it's a great time to flip houses, woo-hoo, right? So how do I experience that? Now I know the answer to this, but I want to feed it back to the panel, right? How do I experience that with what you just said and go like, how's the market not killing it right now? I need to start just selling more houses.
It's musical chairs, and the music hasn't stopped. And the day that everything opens back up and we see the true number of sellers and the true number of buyers, that's the music stopping. And I'm not saying, when I say the music stops, I'm not necessarily saying there's going to be a crash in real estate, but I'm saying that's the day that we're going to find out what values truly should be.
So Taro, I love what Jay said, because here's one of the things that maybe will help people. I went and took a look at flights from LA to Miami, and in the middle of March, they were $3.25 for a coach seat. Then they went all the way down to about $1.25. You could fly to Miami from LA for $125 a seat. Now, the reason is because the supply was there, the demand was not. That's what happened. Then the airlines put a bunch of planes away. As you guys have seen all the pictures, they're they're sticking them on runways. And so now the supply went down, the demand was met again, and now that those prices just in 2 months are back to like 350. And that is what he was talking about. Was right now we have a demand reduction and a supply reduction. We have both, and you got to just pay attention to where they are. And in the airline example, that's the reason why they went up, because now the planes are full again.
I guess that makes sense, because the thing I didn't share is that in a 3/4 mile radius from this house, we were the only house on the market. So
yeah, exactly.
Maybe that has something to do with it. I don't know.
It wasn't because you're so handsome.
What do you mean? So Mauricio, so I know that you specialize more on the raising capital and so forth, but what are your thoughts on what everybody else said right now?
I mean, I'm going to echo, I right before this webinar, actually, I went into my other office and to pull out my crystal ball. And for some reason, it wasn't working. If the battery wasn't working, electricity. So I can't rely on it. But in terms of predictions, I definitely, Kenny and I think are pretty aligned. I know one thing for sure, that by the end of the year, we're not going to have recovered all 35 million unemployed. Yeah. I do think you're going to see some ridiculous headlines, because there's going to be a week where you have 2, 3, 4, 5 million. It's going to be historical gains. But net, the question we just don't know is how many of those jobs are still going to be not there at the end of the year. And Kenny and you got to check out the video. It's amazing. Is it 10%? Is it 20%, 30%, 40%? We don't know. And so once we know that, then we'll have a better idea of what the supply and demand chain looks like. The other thing that I think you cannot overlook, and Kenny, you mentioned it briefly at the beginning, is the stimulus, not just the $1,200 that everybody got or whatever, but the unemployment. People forget, and I know a lot of this because I used to be in the mobile home park space, but 50% of Americans live on $600 a week or less. And so I don't know if that's a magical, and that's how they came up with $600 a week for the federal bonus money, but there's certainly that has filled the demand gap right now. And what we don't know is, when is that going to run out? Is it going to expire here in July? Are they going to renew it for another 6 months? Are they going to renew it at a lower amount? I was reading an article, as many people know, a lot of people are actually making more money now unemployed than they were at their jobs. And so there's no incentive. They're actually, the private companies are actually competing with the government for those jobs, because they don't want to leave their homes. So I saw an article either yesterday or today that they're considering maybe extending it, but extending it for less. Instead of giving $600 a week federally, they'll give them $300 or $250 or something like that. But I mean, obviously, if that game continues for another 5 years, then that's one thing. But if it ends in July or ends in August, whenever that ends, it's going to have a huge impact on all of this stuff. And then where I think the only place I disagree with Ken is, Kenny and I are both super optimistic, but Kenny's projections of once we get back at the end of the year, the projections of how we recover from there. I think you were coming out with like $2 million a year, 2 million jobs a year. And I'm like, there's no way we're going to be gaining 200,000 jobs, a week at the beginning anyway. Maybe 3 or 4 years from now, we might see those numbers. But I think that's where you're a little optimistic on the recovery side. But I'm also a little bit more optimistic. I'm hoping it's not 40%, man. That would be awful. But even if look, again, it's not going to be 0. It's going to be 20, 30, 25, 40, whatever the number is. And hopefully that number is low. But even at 20%, you're looking at you're looking at 7 to 10 million unemployed. And those people are not going to be able to make their mortgages. They're not going to be able to buy stuff. And it's going to be something that we have to wait once it's really all this artificial demand that's there right now. We've got to see what happens when that gets removed.
Here's the other thing. Here's the other thing to think about. Sorry, I didn't mean to cut you off there, Charles.
Right, it's your show.
Here's the other thing to think about. We look right now, and we're talking about 25% unemployment right now. And you think, well, if all of these businesses are kind of having problems, if we're going to see 40% of businesses go out of business, 50% of businesses go out of business, why are we only seeing 25% unemployment right now? And the answer is that there is small business stimulus as well. There are a lot of companies out there that took PPP money, which is the SBA loan, where they have to use this money for payroll. If they don't use this money for payroll, they then have to pay this money back, or they can keep it and pay interest on it as a loan. But they'd rather use this money for payroll. So there are a lot of companies, and I know business owners out there that literally have gone to their employees and said, I'm going to pay you not to work. I took this PPP money. We don't have business. I'm going to pay you not to work for the next 8 weeks because it's 8 weeks worth of payroll. And then when that money runs out at the end of June, a lot of those businesses are going to shut down. So there are a lot of businesses right now that are in business for the next 6-8 weeks, but they know that when that 6 or 8 weeks is up, they're out of business. And so I think at the end of June, we're going to see that unemployment rate go from wherever it is. Maybe, I mean, I don't know if it's going to be up or down between now and then, but at the end of June, I think we're going to see a spike downwards on that unemployment rate when PPP money runs out. And a lot of these businesses finally say, we can't make it. We're shutting down.
And just one real quick. I saw this morning too, that they're expecting another 2 to 2.2 million unemployed, when the figures get released tomorrow, and then they're projecting another 1.5 million or so the week after. So I got to believe at some point we're going to, there's certainly going to be some jobs created here in the next couple of weeks. But so that final number is going to be, it's going to be about 40 million at some point in the next couple of weeks.
So I want to jump in here. I like one of the comments we got on Bigger Pockets, right? It kind of summarizes everything, which is from Jared. He's like, so basically what you guys are saying is no one knows what's going to happen until it happens. So,
and we're 100% sure of that too.
Yeah, we're sure of that.
Guaranteed. You want a guaranteed investment, invest in that. So but in reality, guys, like for everybody listening to this and watching this, is that we're discussing this as a point so that you guys can take this information and make your own decisions with what you want to do in your investment career. All 4 of us on this panel right now, we all are involved in this industry in some capacity, and we all have to make decisions to how far fast we push forward, how much we pull back, adjust our balance sheets, whatever it might be, and based off of the information we're sharing with you guys right now. So that's the best we can do. So what you choose to do with it is the best you can do. So now switching gears a little bit, so Mauricio, we had a conversation yesterday, and you had brought up like lenders and stuff, so forth a little bit. Like one of the reasons why people raise money in syndications is because they can only borrow a certain amount of money from the bank, like in multifamily, and then they have to make a down payment for the rest, right? And one of the questions is, what have you seen with lenders tightening lending for residential and multifamily? Let's talk multifamily as well. How is that affecting your clients in any capacity? Do you see anything with lenders right now with multifamily being tightening up or anything along those lines?
Yeah, I mean, one of the things that we've learned is that lenders have so much leverage. They literally, the documents that you sign aren't worth the paper they're written on. I mean, they have so many outs in their legal docs. If you really take a look at mortgage documents, you'll see that they can basically get out for any reason because they feel uncomfortable or they're not quite sure. So we saw a lot of lenders pulling out at the last minute, and a lot of them coming back and saying, look, we'll give you the loan. But for example, here's a big one. A lot of them were requiring additional reserves. Interest reserves. So where, before this whole happened, maybe you needed to put together 6 months of reserves. Now they were expecting 12 months. And again, if you've raised the capital already and you're about to close next week and suddenly the bank comes and says you basically have to come up with more money, well, crap, I got to go back and raise more money. Or what we were getting a little bit creative, we were working with sellers, and the sellers sometimes, look, from a seller's perspective, our clients were their best chance of selling that property at that point. They didn't want to put that back on the market and wait another 90 days. So they were working with our clients and maybe, doing a seller carryback or something to cover that. LTV ratios were coming down a little bit as well, or going up, I guess. So because typically they'll last for 20%, and then you've got all the value add. So typically you're raising about a third, 30 to 35% of the total purchase price to cover your down payment plus all the value adds. So when the lenders came back and changed the reserve requirements and changed the LTV, that caused a lot of problems because of that shortage. Like they've already done with the raise. Now I got to go figure out how do I make up that difference. So that was causing a lot of havoc. I think now they're coming back a little bit. I just had a client that bailed on a property and then is re-engaging. And he's telling me that he got a better deal, better lending than he did at the beginning. But it definitely, it definitely caused havoc. And again, it all goes back to that unknown. The lenders just didn't know how to value the property. I mean, they had an appraisal from 2 or 3 months ago. They were assuming you were going to have 80, 90% occupancy. Well, what's that occupancy going to be in August? you know what? It depends on how many unemployed. It goes back to that original thing that Kenny does such a great job of in his videos. How many unemployed are we going to have in August, September, December? And then the lenders will have some level of confidence that you'll be able to raise, to get the rents to pay them. That's what they want. The lenders want you to pay them.
Yeah. Right. Isn't that weird? Yeah. So it's all about mitigating risk on their end. So they're using projections and thoughts and where they think things are going to be. And
I'd be interested with, you guys, with the whole forbearance thing. I mean, this is kind of a unique, at least in the single family, where they're now extending forbearance, which is also going to delay a lot of what's going to happen. But an interesting twist is that the forbearance, they're just going to tack it on. It sounds like they're going to tack it on to the end of the loan, which is a huge difference from suddenly 6 months from now or 12 months now that you need to come up with a lump sum payment. So I'm interested in you guys' opinion as to how that's going to affect prices in terms of the forbearance rules that are basically being enforced with the lenders.
Well, so we're dealing with that. Well, a couple of things just to put on what you said, Mauricio. I read a really cool study about from the mortgage lenders that said 71% of the commercial real estate deals died in the last 2 months. 71%. And so what I've seen, I was playing golf with a friend of mine this weekend because, of course, in Arizona, golf's essential. So anyway, he was selling 2 multifamily deals, and the buyer had wired $1.2 million into escrow, which flowed to the seller, which was him. And then the bank said, we're not going to finance it, so it was in the middle of that. And so now there's fights at the escrow level over earnest money. So be really careful if you are going to do something, because, make sure you guys are reading your documents. And so that's just one thing I wanted to say. But on the forbearance side, you have to show the lender that you've been harmed some way financially in order to even open that discussion. So, on the multifamily side, we're not seeing it as much, but on the retail side and some of the obviously the malls and things like that, we're seeing it a lot because the tenants aren't open, so they're not collecting revenue. Then the tenants aren't paying the rent, so the landlord can't pay the mortgage, et cetera, et cetera, et cetera. And so, but on the multifamily side, especially the multifamily, it's been pretty good. But my experience, we had one deal that we were talking, and we have property in Tulsa, Oklahoma, where the oil and gas has just got annihilated, and we've had some collection issues on that one, and so we're in forbearance discussions, and and so obviously, if you're buying anything in Tulsa, it's going to be severely marked down because we have a very nice property in Tulsa. And we're barely making the mortgage payment after operating expenses. And so because that's how much that market got hit. So that's back to what Jay was talking about and Mauricio, is the valuations that these guys, these banks and these lenders had in let's say March. If you're getting a loan in February, March, and now you're seeing big delinquencies, you're seeing skips, abandonments, you're seeing, big markets really got hit, like specifically in the oil and gas areas, like in Houston and Tulsa, et cetera. So, those are all going to show up the way they show up, and the market will correct itself based on cash flow. At the end of the day, it's going to be, if Jay tries to buy in Tulsa, he's going to look at historical occupancy and where it settles in at, and the operating expenses, and he'll make an offer based on the cash flow and the debt, and that's how you do it. And that is going to actually ultimately depend. That will value that real estate in that market.
Okay, so we are going. Everybody catch that? So for what we're going to do now, we're going to start shifting gears into answering some of you guys' questions. I am going to sit there. I am going to say one thing about, kind of similar to what you're saying in Tulsa, and how unemployment is such a huge factor in a lot of our opinions as far as what might happen in the real estate world. Switching gears into this is that for the airline industry, you gave an analogy on the airline industry, Ken, about supply and demand. And there's been a lot of speculation on what's happening in the airline industry. And in my industry, my area, neck of the woods, Boeing is a huge employer, right, for the Seattle market. Everybody thinks it's Amazon. Yeah, Amazon's huge too, right? I get it. But Boeing is like just as big. Right? It's pretty in depth here. And Boeing's making a lot of issues saying like, hey, we're going to go out of business here soon, like all this kind of stuff. Is there any other industries we should be looking at that are similar to like a Boeing going out? Because if Boeing goes out of business here in Seattle, I can't see how that doesn't affect our real estate market. Are there any other aspects that we're thinking about besides you brought up malls earlier too? Jay and Mauricio, do you guys have any thoughts on other industries we should be looking at right now that might be your city might be that industry for all we know? Or
Well, anytime you have an area that is dependent on a single industry or a few number of industries, you need to be concerned. I mean, one of the things that good investors look for is employment diversity. They want to see that there's a lot of different industries. That's one of the reasons why I've kind of avoided buying too much down here in Florida. Most of our economy is tourism, it's hospitality, and in a downturn, what gets hit the hardest? Tourism and hospitality. So I expect areas like Florida, maybe Las Vegas, to get hit a lot harder than other areas that are a lot more employment diverse. And so you look at something like Seattle. Yeah, Boeing is a huge employer in Seattle. But if you look at Seattle Metro, it's a pretty diverse employment there. So yeah, that would cause a hit, but it wouldn't be the type of hit you'd see in a place like Orlando or a place like you'd see in Las Vegas or maybe even San Francisco, if there was some major issue with tech. And actually in tech, we are seeing somewhat of an issue in terms of working from home. Number of tech companies, big tech companies in Silicon Valley have basically said, we're going to allow our employees to start working from home. So what happens when Twitter says not a single employee ever has to come back to work? What are those employees going to do? Are they going to keep buying $3 million one-bedroom houses in San Francisco? Or are they going to move to some place like Nebraska where they can work just as efficiently, but they can live for 100th the price? And then what happens to real estate values in a place like San Francisco when all these people start moving out because suddenly they don't need to be local to their employer? So everybody needs to look at their specific situation in their market or their markets and ask the question of, how is this pandemic going to play out here? How is the impact of what we're seeing going to play out on my particular market in terms of employment diversity, in terms of population growth, in terms of just the types of businesses that are likely to go out of business?
It's that's one of the most interesting things I have too, is that trend of how many people are going to end up working out of their homes. By the way, Boeing, I read today, was laying off 6,700 people today. But yeah, that's one of the, I was going to mention that. You kind of stole my thunder, Jay. Thank you. But that was one of the trends. Facebook, I think, announced that they were going to allow their workers through the end of the year to work out of their homes. And if they're just as efficient at home, I mean, I have a home office now for 15 years, then is that a trend? Now, I don't know if it's going to impact so much people leaving the state to a different state, because even though the cost of living may be lower, I'm also hearing that companies will also be adjusting the compensation model if you move out of state. Like if you're in San Francisco and you move to Nevada, well, your salary might get cut in 20 or 30%. But certainly they may be moving out of the metros, the downtowns, or wherever the offices are, and they may want to go move into the suburbs or somewhere with a nice backyard and not everybody on top. I mean, that's happening in New York a lot already. The people are looking to move. And if they can do it from work, then how is that going to impact real estate in general? And I'm, just in the middle of like everyone, just kind of studying and looking at what that looks like.
Yeah, Ken said it earlier, and I think he mentioned it briefly, but it's probably the most important thing that's been said on this call is everybody out there needs to be following the trends. It's great that you follow these webinars that we're doing and you're asking us what we think, but you need to be out there really following what's going on in your markets and making your own predictions. And that's why it's so important to understand how real estate works, how the economy works, because at the end of the day, don't trust what the four of us are telling you. Kind of go out and figure out what's going on in your market and your whatever your niche is, and figure out where the trends are headed.
Awesome. Thanks, guys. So, all right, jumping in the next question. This is more of a nuts and bolts question, and I might just to get this because a lot of people upvoted this one. Lenders tightening their requirements. How can you successfully run your numbers on flips and burrs, buy, rehab, rent, refinance, repeat, if you don't know what kind of rates your portfolio and or hard money lenders will charge in the future? So I'm just going to knock this one out really quick. I don't calculate what my lenders are charging me on a flip up front because I rate the entire deal off of cash on cash as if I'm buying the whole project cash to begin with. So I get that margin of risk. I want to find out that cash on cash deal. And if you just look at any kind of deal that is for us, we look at 20+% cash on cash if we buy it all cash and rehab it all cash. And if it's at least 20%, it doesn't really matter what my lender's charging me. We're still going to be good to go because it's enough margin of risk in there for that. So that's something we do very quick. I've never looked at it the other way. That's all I've ever done for years. And so on the back end, though, for a rental, you should be concerned about whether or not you qualify for it and what your lender terms are going to be. And that's something that you have to start like digging into right away that we can't give you an answer for because we don't know what 6 months is going to look from now. We know today rates are super cheap for even investment properties. Cash out investment, you're going to pay a lot more on points to be able to get that out from your traditional lenders and portfolios, if at all. But the rate will be low, but you're going to pay a lot of fees. So if you want that cash out, so I would be looking at that pretty closely if you're doing any kind of back end refis. So hopefully that answers your question. We can get more on that. There's other things I've done for you for Bigger Pockets that answers that way more in depth. So go check that out on YouTube for Bigger Pockets.
And by the way, Paul, just one comment on that is that the rates are really low, but how easy is it to get one of those rates? I mean, certainly the down payment has to be much larger than it was before, and your employment history needs to be pretty solid, and you need to have your ducks in a row to be able to get those rates, right?
So yeah, all right. So here's what caveat, then we'll move on. Most house flippers have the worst financials ever, right? So I just want to throw that out there. So if you are flipping houses and you want to transition to BRRRR, you have to get your finances in order, right? File your taxes correctly. Go get an escrow. I'm not going to give all this advice out, but definitely get your ducks in a row so you can get that better financing, or else you're going to pay. There's plenty of institutional lenders out there that'll lend to you at a 6, 7, 8% or whatever, but on the back end. But you want to pay that. If you want those 2, 3, 4%, 5% back ends, then you're going to definitely need your financials in a row. So excellent advice. So, all right, this question here, I don't know the answer to it, so maybe you guys can help out. Typically, condo units are not great for long-term appreciation. This comes from Corey. And do you think condo prices will drop, and could we be seeing a condo becoming a good investment for cash flow and for rentals later?
I'm a fan of condos with a lot of disclaimers. One, typically condos, yeah, they're not great for appreciation, but if you're investing for cash flow in a decent market, that may or may not matter to you. But the bigger risks with condos are one, homeowners, condo association fees can change on a dime. So you might be paying $200 a month in condo association fees and you're cash flowing just fine. And then along comes a special assessment next month because the place needs a new roof, or there was some problem with the builder and they need to go back and fix a whole bunch of stuff. And now your $200 a month condo association fee is at $900 a month. And that's a real number for a condo association right down the street from me where I almost bought last year. They went from $200 to $900 a month for the next 3 years. So that's the first risk, is that you have a lot of variable costs like condo association fees that you don't control and that can really hurt you longer term. The second is condo associations. At least back during 2008, we saw a lot of situations where owners in condo associations didn't like the fact that all the other owners were starting to rent, and they started implementing rules that said we're only going to allow X percentage of rentals in the association. So it might have been 25 or 50% of rentals. So if, let's say, the association decided we're only going to allow 50% of the units to be rented, and now we're already at 50% and you want to rent your unit, you may not be allowed to rent it. So that's the other big risk, is that condo rules can change, and it could prohibit you from renting, or it may force you to rent long-term as opposed to short-term, or it may change in
so there's always a lot of stuff you got to figure out before you invest in something.
So, but condos are a lot more risk than single-family homes.
So, but Ken, did you ever do any condo conversions in your day?
Yeah, I've actually got a lot of experience in building condos and condo conversions, and we've done thousands and thousands of units. And so, we actually set up the HOAs. So we would buy, say, a 200 or 300 unit apartment building, set up an HOA, sell them off individually, and, you know, seed the board and go. So Jay's right on. So what happens typically, condos are typically at the end of every real estate cycle. So you need to know that. So if you go back in the 80s, and the 90s, and 2000s, what happens is housing prices go like this, and all these prices go like this, and then all of a sudden, a 1,000-unit box becomes less than a house that's up here. That's the why condos work. And he hit the nail on the head when he was talking about assessments. And so, especially during what we're heading into, because condos are typically, you know, thinner down payments because they're less money. And, you know, a lot of them are not letting VRBO and Airbnbs in, and, you know, and on the rental side sometimes, and those homeowners, those board of directors, they change every couple of years. And so every year people come in and they try to change those bylaws and the CC&Rs and things like that. And they, you know, which have to happen by 75% vote. But I've seen it. I've seen some, you know, rules change in condos a lot. And the one thing to remember is that when we're heading into a recession, you're going to start to see condos first probably come out on the default side, would be my guess. And when those units are owned by the bank, or there's people that can't pay their HOA dues, then you get into what Jay said, because the entire condo project is based on everybody paying and being able to do maintenance and cover their bills and all that kind of stuff. And so when there's condos that default or can't pay their HOA dues, then they're just like, you know, we're talking about here, there's not enough money to pay the bills. And so that's when the assessments come. That's when the rises in the fees come. And so condos can be super complicated on an investment side.
And,
Thank you.
and on this, just because on the security side, I mean, that's definitely the largest risk we look at. I mean, the one thing you want to really pay attention to is that reserve. The HOA will have reserves and they'll tout the reserves, but you can actually get reports. Somebody can actually do a good analysis on those reserves and let you know. It's almost like getting a survey on the roof or whatever. You can actually get an opinion on the reserves and whether those are going to be adequate and what the risks are of a special assessment based on the condition of the condos. But that's something you want to really pay attention to. And if you're raising money, that's going to be one of the main risk disclosures we're going to be providing the investors.
Fair enough. Cool. All right. We learned a lot about condos today. Moving on.
Yeah.
For this question, actually, I ask this type of question on the webinar, and it is actually a great question from Justin. And just to summarize what he's saying is that the U.S. is printing for lack of a better word, shit ton of money right now. And how is that going to, what are you guys' thoughts on the effect of the dollar? Is there any concerns about the dollar collapsing in the near or late future or anything along those lines? And what are your thoughts on inflation, deflation, and all that kind of stuff? And what's going to happen to our dollar? Any thoughts?
Yes.
Ken.
Well, a couple things. And of course, I'm not an economist, but in 2008, when we went through this, the QE went to the banks, you know what I mean? And so, and a lot of those banks paid that back, and a lot of that was, you know, to save the banks. This is different, where this is going right to businesses and people. So that's a very important part, because the money is going right out in the economy. I don't know if you look, but this week, savings rates are up the highest they've been in 30, 40 years or something. You know, we're at 14% savings rate. It hasn't been that high in a long, long time, which is good. So people are heavy in cash. You know, I was lucky enough to be on a couple podcasts with some big minds around this issue. And they said, you know, you've got kind of a window, like a 2 or 3 year window, you know, or a lag, I guess, because people are going to hunker down on their cash, and until it starts flowing and starts being spent again and people start getting back to their normal behavior, it actually doesn't make it out into the system. And so, however, being that said, grocery prices are the highest they've been in 50 years, you know? So there are things that are higher, but there are things like gas that are lower. But generally, I can't see any way around us not having pretty significant inflation. down the road at some point. I don't know enough to say that, but I do know that you've got what, 4, 6, 8, 10 trillion coming out into the economy. And I don't know how you can't double, triple the money supply and not devalue the dollar a little bit.
What does that do to real estate then, if that happens?
And that makes it go up. I mean, if you have fixed rate debt, let's say I have a $20 million loan on something and it's 20 million in 10 years, it's still 20 million in 10 years. You're paying it back with cheaper dollars, and so things go up. Think of the house you grew up in. That's what I like to tell people. My mom still lives in her house in Seattle, actually. I think that, it's 15 grand for that house. At the time, it was a massive stretch for them, right? And then there's all these things that have happened, and a lot of it has been inflationary. Think of cars, think of, just things that look at $100 bills, man. They're like fives now. You know what I mean? So, that's part of that, I think. We'll probably see a bigger bill come out at some point, I would guess.
And that's one of the main attractions of real estate is the debt. A lot of people get into real estate primarily because it's easy access to debt because it gets inflated away. The other thing I've been thinking a lot about is just interest rates, right? The Fed is printing a lot of money and they're buying the bonds primarily to keep those interest rates down. And as we've seen, in my opinion, a couple of years ago when we tried to get those interest rates a little bit higher, it didn't really work out too well, and they started reversing even before this whole happened. But I just don't see a scenario where the Fed doesn't have to continue to buy bonds in order to keep those, interest rates low. And if they stop buying bonds and the price of bonds go down, that means interest rates go up. So to me, the Fed has to continue to print more and more money in order to continue to buy these bonds, to continue to keep the interest rates low. And by definition, the expansion of the money supply is inflation. Higher prices are a result of inflation, of the increased money, but the inflation is the inflation of the money supply. So I'm with Ken, not surprisingly, once again. And so real estate's great, precious metals are great, anything that's a hedge against inflation. There's another great article on Social Security today. There was an article, I think it was Market Watch, that said that Social Security benefits are getting cut next year, not because the dollar amount's going down, but just because of what we just talked about. The Social Security is probably going to stay about the same, but your grocery bills are going to be much higher, and so that's effectively a decrease in your fixed income. So it's going to be a big deal, I think, for sure.
Yeah, there's a lot of talk about inflation, deflation, and certainly the conventional wisdom is you print a lot of money, which and Mauricio is right. The definition of printing money is inflationary. I mean, you're increasing the money supply. That's the formal definition. But from more the CPI that we think of and the price of goods going up, I like to think about inflation and deflation as like a seesaw. And a seesaw, if you have one person that's heavier on one side or one thing that's heavier on one side, it's going to tip down, and heavier on the other side, it's going to tip up. And really that's what inflation and deflation is. It's a seesaw. And there are different things that lead to pressure on one side or the other. And so certainly printing money is a really heavy weight on that inflation side of the seesaw. But there are plenty of things that can cancel out that printing of money on the other side. There are a lot of factors that influence both sides. So again, printing money is a huge one, but efficiency of production is another huge one. And so automation is one of those things that if automation can keep pace with our expansion of the money supply, we may even see deflation. So consumer demand is the other huge one. Like Ken said, without consumer demand, you don't see inflation. Inflation is the result of businesses needing to spend money on inventory and equipment and workers to keep up with increased demand. If you don't see that increased demand, businesses don't need to spend the money, and you're not going to see that cost passed on to consumers. You're not going to see inflation. So you have to take all of these things. You have to take the aggregate money supply. You have to take demand. You have to take efficiency of production. You have to take interest rates. You have to take efficiency of trade. I mean, there are really a million different things that kind of weigh on both sides of that seesaw. And until we know how each of these things is going to play out over the next few years, I've seen some really smart economists say we're going to see deflation over the next few years. I can't argue with them. I've seen other economists that say we're going to see massive inflation over the next few years. Can't argue with them. The point is there's so many variables, there's so many factors that we can't predict a year or 2 or 5 down the road. We don't know. All that said, I definitely see a risk to our currency. And the biggest risk I see to our currency is if we print a lot of money, we run the risk of those people that buy our currency, large companies, large investors, countries, to lose faith in our dollar. We can't raise interest rates as we're printing money, because if we raise interest rates, we're going to have to pay more on that debt, and we can't afford to do that. So my take is that we're going to see interest rates near zero for a long time, at least until one of two things happens: until the Fed starts selling off all these assets that they purchase, which they rarely ever do, or until our currency collapses. So I think we see interest rates at 0% until the Fed gets their shit in order, or we see something really bad happen with our currency.
Anybody have any real fears that we might lose the dominance in the world for our currency, or?
I don't. No, I heard a guy, I went to a hedge fund conference in Laguna Beach right before all this. And these are all the big guys, Invesco, KKR, they're all there, Blackstone. This came up, and I thought the guy said it really well. He goes, we're the cleanest dirty shirt. And everybody laughed. And what he meant by that was, where are they going to go? I mean, are they going to go to the euro? No. Are they going to go to, I mean, think about it. The yen, we are 70, we're the world's reserve currency. We're 70% of the world's money right now. And there's not a good alternative. And I think that's true.
But by the same token, if we piss off the rest of the world and the rest of the world decides, hey, we don't want to play nice with the US anymore because they're not playing nicely with us, all it takes is a concerted effort amongst a bunch of other big nations to decide they don't want us to have the reserve currency anymore, and they can put up a big fight. Hopefully that won't happen, but I think if you look historically, reserve currencies last between 100 and 150 years.
Right.
And so I think what's more likely to happen is the US dollar will go away, and it will be replaced by another currency that the US controls at some point 5 to 10 years down the road. I don't think this is a next year, 2, 3 thing.
Yeah, that could happen.
Several years, I think we'll see the replacement. We'll basically see, and we saw this back in the 40s. And anybody out there that's more interested in this, take a look at do a search for Bretton Woods. And basically after World War II, the whole world got together and said, we kind of have to figure out this whole currency thing. And we kind of re-pegged currency back in 1944. So it's not something that never happens. We just don't talk about it a lot because it's been 80, 90 years since the last time.
All right, so we're going to be wrapping up, and before we wrap up, one last question for you guys to answer that I'm going to throw out there. What is number one advice right now for somebody not to do as a real estate investor currently, what you believe, or what do you think number one advice people should be doing right now as an investor? You could choose which one you want to give. It's up to you. So let's start with Jay.
I would say, and it piggybacks on what Ken said earlier that I love, is we need to be following trends. I'm not one of those people. I think there's never a bad time to buy real estate. I like that saying, generally speaking. But I think right now, if you're not an experienced investor, now's a good time not to be buying real estate. Anybody out there that not really sure if they should be buying, they probably shouldn't right now. I think that'll change in a few months, but don't feel like you have to be out there buying. Now's a great time to be learning, go read Ken's books, go listen to everything Mauricio's written and said on syndications and securities. Go watch all of these other webinars that Taro and I have done over the last few months. I mean, now's a great time to be learning and educating yourself and putting together a business plan and working on your credit and working on your cash and finding partners and creating a plan so that in a few months, when opportunities do emerge, and opportunities will emerge, we just don't know where or how, but when opportunities emerge, you're prepared. So now's a good time to really start getting prepared.
And let's let Kenny do have the last word. So I'll just say real quickly, again, kind of stole a little bit of my thunder. I think, look, patience is critical. one of the listeners said this at the beginning. We don't know. Like, nobody knows what's going to happen in the next 2 to 3 months. Like, literally, you can make some guesses or whatever, but have patience. Shore up your financials. You were talking about that, Tarl. You know, get your financial house in order. Get the cash ready. Cash will be king. And then once you have a little bit of clarity, once we know how many jobs came back or didn't come back, and we have a little bit more clarity, that's when I think is when you would at least start making decisions. I'm not even saying it's ready to invest, but start making decisions there. A more educated investment decision, as opposed to right now, we have no idea what's going to happen.
Thanks, guys. A lot of what everyone said. The one thing that happened in 2008, as you know, I had an incredible run, almost $1 billion worth of acquisitions during that time. And the entire thing that I said was, look at all we had a home ownership rate of, it was very high, and a renter rate of around 62%. And I said, you know, we're going to see a good 6 to 7% increase in renter rate. And that's going to be anywhere from 6 to 10 million more people coming into the rental pool. And it's going to put all this stress on the rental market because there's not enough supply. That was the entire way I raised all that money. And that's a trend. And so that's what Jay was talking about. And that's what I'm talking about. And so we're going to see another trend. And if you can see something that's going to happen, and you can teach your investors and your banks and, you know, and some of your partners that, hey, this is something I see, and it's really truly happening, there will be people that will jump on it and help you get very wealthy during this next trend, whatever that might be. But the one thing that I see, people are impatient right now because they have, you know, some investors, and they have, you know, money, and, you know, they have these tools. Maybe they, you know, they've done it a few times, or maybe they've done it a while, and they feel like they need to do something. And I know what that feels like. It's, you know, you want to go out and buy something, you know, and you're like, well, when's this over? And they want answers, you know. That's why I did that, excuse me, the financial stress test video, you know. And by the way, I have that on the download at kenmcelroy.com, financial stress test. But that is you got to take inventory of where you are financially, and then build from there. And don't think that just because you were buying in the first quarter that you have to buy in the rest of the year. That's been discipline has been hard for me over the last 2 years, because, you know, people were overpaying in the last 2 years in my space. And I was losing deals, as Mauricio knows, $1 million, $2 million, $3 million higher than me. And I'm like, listen, guys, I don't want to be behind this preferred return. This thing is a little thin. You know, let's pivot, and, you know, let's start our new construction and development, which is what we did, instead of jumping on board with that value add strategy that got me a long way. So this is a pivot time. This is a time to stop what you're doing and take a look at whether it's going to work in the next 6 months, because you can ruin all your relationships that you've built with your investors if you drag them into this. They're going to expect you, as the leader, the one that's putting these deals together, to know better. And so that's the one thing that you can do.
That is incredible advice. If you guys aren't taking note of that, make sure you take note of that now. Also, go to his website, do your financial stress test as well. Check out Ken's YouTube channel. Watch that video, that link that we posted earlier as well for you guys on his thoughts on the economy. He's got a lot of videos. You guys, Ken, you put out so much content and stuff, and so much good stuff for people. We really appreciate that.
Yep.
Same with you, Jay. You're always out there grinding it. Mauricio, I don't know what you do. So
I try to keep up with Kenny on the videos.
That's right.
Keeps me out of jail.
Everybody here on this are all educators, all trying to do their best. None of us really have any real massive benefit from doing these for you guys, but we definitely and all enjoy doing it. So, Ken, how can they get a hold of you or find out more about you besides your YouTube website?
Yeah, www.kenmcelroy.com. Thanks, Tarl.
Yep. And then also you're on Instagram. I see that all the time. And I know it's you posting every time, right? So, Jay, how do they get a hold of you?
jscott.com. Check out the Bigger Pockets Business Podcast. And I have to say one other thing. This isn't talked about enough. So in 15 minutes, SpaceX is actually putting 2 astronauts in space. Like, how is this not the biggest news out there? So I just got a note that it got pushed from 4:10 to 4:30. So when you hang up from this, everybody go watch the SpaceX launch. This is really cool. How's that not bigger news?
Good point. All right. Mauricio, how do you get hold of you?
YouTube on Mauricio Rauld, or website premierlawgroup.net. I think I also have mauriciorauld.com, not to get out, not to get outwitted by these other guys. But yeah, premierlawgroup.net or Mauricio Rauld on YouTube, and obviously Facebook. That's probably where I'm most actively right now.
Awesome. Love it. Love having you guys on here. We'll do this again. Hope you guys enjoyed it. And
Tarl, we get in touch with you.
Yeah. Yeah. Well, I don't know. Google me. I'm the only Tarl Yarber in the world. So but besides that, you can also follow me on Instagram at Tarl Yarber. Go figure. And also, we do a lot of content for Bigger Pockets. Fixated on realestate.com for everything we do is free. So check it out. And we do have our expo coming up, but we'll talk about that another time. And we will see you guys in the future. 2 weeks, next webinar. Check it out.
Cheers, guys.
Bye,
guys.